In Money Watch, another top story that we're watching this morning is the action on Capitol Hill. The countdown for Congress to approve a government funding bill is quickly approaching as lawmakers remain deadlocked on raising the debt ceiling. So yesterday, the House passed legislation that would suspend the debt limit, but it's not likely to succeed in the Senate. If lawmakers can't come to a compromise, the government could go into default, impacting the wallets of millions of Americans. So here to break all of this down for us is Federal Reserve economics and banking reporter for Yahoo Finance, Cheung. Thanks for joining us, Brian, because I think it gets really confusing. People hear the debt limit, raising the debt ceiling, the deficit, all these D words. They know it means that we're running out of money, but they don't really know exactly what it means in terms of how it impacts us. So let's break it down. Unless the debt limit is increased, when could we actually see the government running short of cash? And then what happens then?
Yeah, well, it's great hopping on the show this morning, Anne-Marie. And of course, when it comes to debt ceiling, never a good discussion you want to have if you're talking about anyone not being able to pay the bills, let alone the United States government. But to kind of break down exactly what the debt ceiling itself is, it's a statutory limit really on the amount of money that the federal government owes. And it's supposed to be a mechanism to enforce prudence over government spending. So the idea is that if you have this statutory limit, Congress is going to have to debate how much debt they're allowed to accumulate. But it's important to remember that really it has very little ability to actually stop increases in spending. Consider an example like a parent, for example, telling a kid, hey, don't go spending more than $500, but they already have a credit card. And on that credit card, they've already spent $600 or $700. So at some point, someone's going to have to pay that bill anyway. So again, the debt limit itself as set by Congress doesn't actually limit spending that was already authorized. We know the case has been, during the pandemic, there were trillions of dollars in spending that were unanticipated from both sides of the aisle. And ultimately now those bills are coming due. Now, normally since 1917, the song and dance has been for people to get together on a bipartisan basis to raise it. The statistic, I believe, is about 78 times since 1960 that they've either permanently raised the ceiling, temporarily extended it, or just changed the definition. And we'll see if that is again the case in 2021.
Yeah, the thing about it is that's so true that the debt ceiling often gets raised. But I feel like in the last decade or so, there have been more nail biters than ever before. I don't know if it's just part of playing politics, that, when you hear, oh, we're spending more money, they know that, the American public is going to get sort of all tense and up in arms. But it just seems like they're always playing it close to the wire. But really what people want to know is just how it affects them in their day-to-day lives. So what sort of real world effects will Americans face if the government cannot borrow money to continue paying for programs?
Yeah, well, the hypothetical of that is extremely difficult to say because it's never happened in the United States history before. But the stakes would be large, and that's a big reason why Treasury Secretary Janet Yellen has used words like catastrophic or calamity to describe the stakes here if the United States government does default. And that's simply because of the fact that the United States is the largest economy in the world, and our debt, which would look like a U.S. Treasury, so people that buy U.S. 10-year bonds or even 1-month notes, those are all obligations that the Fed uses to finance the government. And of course, it offers bondholders interest payments. So that's what it looks like when the federal government tries to pay them back. We're still doing that right now. It's important to note that even though the debt ceiling was reinstated back in August, since that point in time during these negotiations, the Treasury has been tapping into this emergency cash reserve that it has and other types of what they call extraordinary measures to pay those bills. But the estimate is that the Treasury will run out on October 18th. That's the projection from the Treasury itself. And after that date, it's really uncertain what would happen. Imagine if the United States couldn't start paying those bondholders back. Maybe those credit rating agencies start to lower the credit rating on U.S. government debt. U.S. government debt, the market for U.S. Treasuries is supposed to be the most liquid in the world. Basically, every other type of risk asset is indexed to U.S. Treasury markets. So if those get downgraded, then that can create an entire financial market implosion. And then that would lead to jobless claims and people having to get unemployed because of the fact that businesses can no longer get financing to bridge themselves through, we have to remember, is still a pandemic. So the stakes here are large, but they're also unfathomable. And again, that's because of the unprecedented nature of it. And we'll see if Congress can avoid it again this time.
Yeah, in fact, that did happen once. Now, Congress has managed to sort of claw us back each time. But in 2011, just the debate alone and coming so close to the edge caused the U.S.'s credit rating to be downgraded. What were the consequences of that?
Yeah, well, the immediate consequence was a big stock market kind of rumble. And obviously, that's no surprise when you consider the financial implications here. And Janet Yellen has said the same thing, that this could create a financial crisis. Although the downgrade in 2011, to be clear, didn't ultimately lead to a U.S. default. So the United States was continuing to pay its bills through that particular debt limit negotiation. But it was S&P, the credit rating agency, that said that the dysfunction by which Congress was negotiating that debt limit led them to kind of take down their expectations for the credibility of the United States, which is why they lowered their rating from a AAA to a AA plus, which, by the way, we hadn't been re-upgraded from since that point in time. We've been at that rating for about 10 years now. So the question is whether or not ratings agencies could be ready to do the same thing in this case, that it doesn't necessarily take the ability of the United States to stop paying its bills before they want to do a downgrade. They could do that even beforehand, citing the dysfunction of politics, which we know has been a continual issue in this country, not just over the last few years, but over the last few decades. So I think that when it comes to talking about just kind of the way that markets could react here, pay attention not just to whether or not Congress ultimately raised the debt limit, but the international community's viewpoint of how Washington works and whether or not they're able to legislate things through. Because if Washington in the nation or in the world's most powerful nation can't get anything done, maybe that takes our credibility globally down as well.
Yeah, that's so true. Brian, thank you so much.